History operates with the cold, mechanical precision of a grand clock. It does not move randomly, it moves in cycles. There is a specific rhythm to economic history, a heartbeat that repeats not every decade, but only when a distinct set of catastrophic variables align perfectly. We see extreme asset valuations, debt levels breaking every historical record, dangerous leverage in the darkest corners of the financial system, and a delusional, widespread belief that this time is different. These were the exact conditions on the morning of October 24, 1929. They were the exact conditions in the summer of 2008. And now, as we stand in January 2025, every single one of these red lights is flashing simultaneously. We are not looking at similar conditions, we are looking at identical conditions. The stage is set, the players are positioned, the fuse is lit. If history is any guide, the liquidation event will arrive in late 2026 or early 2027. This is not a prophecy derived from a crystal ball, nor is it doom-mongering for the sake of clicks. This is pure pattern recognition. What I am about to walk you through is a documentary analysis of a crash that has not happened yet, but which follows a script that has been acted out twice before with devastating accuracy. The mechanisms are the same, the timeline is predictable, and the outcomes, specifically who loses everything and who profits enormously, follow the exact same trajectory every single time. We are going to look at why the 2026 crash could be mathematically worse than 1929 and 2008 combined. The scale is larger, the leverage is higher, the global interconnection is deeper, and perhaps most frighteningly, the people in power have already fired all their ammunition fighting the last war, leaving nothing in reserve for the one that is coming. Let us begin with the reality of the ground beneath our feet. It is January 2025. This is the setup. Every major financial crash in human history begins with a bubble. But what we are experiencing today is unique. We are currently living inside the largest, everything bubble in recorded history. Usually, a bubble is isolated, tech stocks in 2000, housing in 2008. Today, it is everything. Look at the housing market. Real estate in major cities sits at all-time highs, completely disconnected from the reality of the people living there. The median home price in America has surged to $420, while the median household income has stagnated at $75. That is a price-to-income ratio of 5.6 to 1. To put that in perspective, a historically healthy, sustainable economy operates at a ratio of 3 to 1. We are nearly double that. At 5.6, housing is 87% overvalued relative to the actual money people earn. In 2006, right before the housing market imploded and nearly took down the global economy, that ratio peaked at 5.0. We are significantly higher than the peak of the last housing bubble. But it is not just homes. Look at corporate America. Non-financial corporate debt in the United States has hit $13.5 trillion, representing 72% of the entire GDP. In 2007, that number was 43%. Corporations are carrying nearly double the leverage they held before the great financial crisis. Then look at the sovereign level. Government debt is at a staggering $36 trillion, or 120% of GDP. The interest payments alone on that debt are approaching $1 trillion annually, money that produces nothing, fixes nothing, builds nothing. It simply services the sins of the past. Finally, add the consumer. The average citizen is drowning in credit card debt, auto loans, and student loans, totaling over $17 trillion. When you combine every sector, government, corporate, household, and financial, the total debt in the U.S. economy exceeds $90 trillion. That is over 320% of GDP. Every single sector is leveraged beyond historical norms at the exact same time. This is the definition of the everything bubble. Everything is expensive, everyone is in debt, and yet, everyone seems to believe prices will keep rising forever. Why? What causes this mass delusion? It comes down to conditioning. For 15 years, since the fires of 2009, the Federal Reserve has guaranteed a safety net. Every single time the markets stuttered or started to fall, the Fed stepped in. They cut interest rates. They printed money. They launched QE1, QE2, QE3, and the massive COVID stimulus. From 2008 to 2022, the Federal Reserve printed over $8 trillion essentially out of thin air. This money did not go into the pockets of workers, it flowed into assets, driving prices higher and higher. An entire generation of investors learned a simple Pavlovian rule: buy the dip. The Fed will save you. The Fed always saves you. This conditioning created the most dangerous force in economics: moral hazard. No one fears risk anymore because risk has been effectively outlawed by central bank intervention. But there is a fatal flaw in this logic. The Federal Reserve is not a god, it is a bank. And it has run out of ammunition. Interest rates were held at zero for a decade. They cannot go lower to stimulate growth without breaking the currency. Their balance sheet expanded from $800 billion in 2008 to $9 trillion in 2022. There is no room left to expand without triggering hyperinflation, a beast we already saw rear its head in 2021 and 2022. The Fed fought that inflation by raising rates from 0% to 5.5% in just 18 months. The fastest hiking cycle in 40 years. They managed to pause inflation, but they created a ticking time bomb. Higher rates act like gravity on debt. Corporate debt that was issued at 3% must now be refinanced at 7%. Mortgages that were 3% are now 7%. This debt burden is mathematically crushing. The Fed is now trapped in a prison of its own making. If they keep rates too low, inflation returns and destroys the currency. If they keep rates too high, the debt becomes unpayable and the system collapses. There is no third option. This is the setup: maximum valuations, maximum leverage, and a Federal Reserve that has already used its tools and has nothing left for the next crisis. Now, let's overlay this template onto the past. We need to compare this to 1929 and 2008 because the patterns are not just similar, they are identical. In 1929, the stock market had risen 400% in 5 years. Margin debt, money borrowed to buy stocks, reached 10% of the entire GDP. Everyone was leveraged. Everyone believed stocks only went up. The most famous economist of the day, Irving Fisher, famously proclaimed just weeks before the crash that stocks had reached a permanently high plateau. He believed a crash was impossible in the new modern economy. Then October came. The market fell 89% over the next 3 years. In 2008, the housing market had doubled in 6 years. Mortgage debt reached 100% of GDP. Everyone was leveraged, buying houses with subprime loans they couldn't afford. The prevailing wisdom was that housing prices never fall on a national level. Then the subprime mortgages started defaulting. The financial system froze. The S&P 500 fell 57%. In both cases, the anatomy was the same: asset bubble, excessive leverage, widespread belief in permanence, a trigger, and then cascading liquidation. The 2026 crash will follow this same roadmap. We have the bubble, we have the leverage, we have the arrogant belief that Fed intervention makes crashes impossible. All we are waiting for is the trigger. So, what lights the fuse? There are 3 primary candidates, and any one of them could start the domino effect. Trigger 1 is the most likely because it is already happening in slow motion: the commercial real estate collapse. Office buildings across America are sitting 40% to 50% vacant. The world changed in 2020. Remote work is not a fad. It is a structural shift. Companies that used to lease 5 floors now lease 2. This destruction of demand is permanent. But the financial destruction is just beginning. These skyscrapers were financed with mortgages at 3% interest rates. Those mortgages are short-term. They are maturing right now and must be refinanced at 7% or 8%. A building that generates just enough rental income to cover its debt at 3% is instantly bankrupt at 7%. The math simply does not work. We are already seeing the giants fall. Brookfield Asset Management, one of the largest and most sophisticated real estate owners on earth, defaulted on 2 massive Los Angeles office towers in 2023. They simply stopped paying and handed the keys to the bank. They did this not because they were broke, but because it was the rational economic decision. The buildings were worth less than the debt. Over $2 trillion in commercial mortgages mature between 2025 and 2027. If even 30% of those default, That is $600 billion in realized losses. Who holds these toxic loans? It isn't the big, too big to fail, banks, it is the regional banks. Small and mid-sized banks hold 20% to 40% of their loan books in commercial real estate. When those loans default, the bank's capital is vaporized. When capital falls below regulatory minimums, the FDIC shuts the bank down. We saw the prequel to this movie in 2023 with Silicon Valley Bank, Signature Bank, and First Republic. Those were the tremors. The earthquake comes when commercial real estate defaults cascade through 2025 and 2026, potentially wiping out 50 to 100 regional banks. Bank failures trigger panic, and panic triggers runs. Trigger 2 is a major corporate bankruptcy or sovereign debt default. During the free money era of 2020 and 2021, hundreds of zombie corporations issued debt to stay alive. That debt is coming due. They must refinance at rates double or triple what they are paying now. Many cannot afford it. If a Fortune 500 company defaults on its bonds, it triggers immediate contagion. Bond investors panic and sell everything else. Yields spike. Borrowing becomes impossible. This is exactly how 2008 spread. Lehman Brothers failed. And suddenly no one trusted anyone. Credit markets froze. The same dynamic applies to sovereign nations. If a major emerging market like Turkey or Argentina defaults on dollar-denominated debt, it creates a hole in the balance sheets of Western banks. Capital flees. Currencies collapse. It creates a global margin call. Trigger 3 is a geopolitical shock. War. A pandemic. A contested election. Something that spikes volatility and forces investors to sell assets just to raise cash. The COVID crash in March 2020 was a perfect example of this. The virus wasn't an economic problem initially, it was a health problem. But the uncertainty forced liquidation. If a war breaks out over Taiwan, or the Middle East supply chains are severed, the flight to safety will drain liquidity from the markets instantly. Whatever the trigger, be it a bank, a bond, or a bomb, the result is the same. Once liquidation starts, the mechanics take over, and these mechanics are brutal, predictable, and devastating. Let me walk you through the 5 phases of the coming crash. Phase 1 is the initial shock. The trigger event occurs. Markets drop 10% to 15% in a matter of days. Investors are surprised, but they are not yet panicked. In fact, the prevailing sentiment is opportunity. The media interviews analysts who claim the fundamentals are strong. In 1929, this was Black Thursday. In 2008, it was the collapse of Bear Stearns. In 2026, it will likely be a regional banking crisis. The Fed will issue a statement promising liquidity. Investors will buy the dip, believing the worst is over. This leads to phase 2, the false recovery. This is the most dangerous phase because it traps the optimistic. After the initial shock, markets stabilize or even rise for weeks or months. In 1929, stocks recovered nearly all their losses by early November. In 2008, markets stabilized for months after Bear Stearns. In 2026, we will see a 3 to 6 month period where the crisis seems contained. The Fed might cut rates modestly. The media will declare victory. But beneath the surface, the rot is spreading. Then comes phase 3, the cascade. This is the real crash. This is when the floor falls out. It is driven by forced liquidation and margin calls. It works like this. Investors who borrowed money to buy stocks are forced to sell when the market drops to cover their loans. Their selling drives prices lower, which triggers more margin calls for other investors, who are then forced to sell. It is a feedback loop from hell. Algorithmic high-frequency trading accelerates the drop. Liquidity disappears, meaning there are simply no buyers at any price. Stocks gap down 20% in a day. Credit markets freeze. Banks stop lending to each other. During this phase, the economy enters a hard recession. Wealth is destroyed. Perhaps $30 trillion in market value evaporates. Companies lay off workers. Unemployment spikes from 4% to 9%. This is the relentless grind down that breaks the psychology of the nation. Phase 4 is maximum panic. This is the bottom. This is the moment when fear is so extreme that people sell high-quality assets for pennies just to get cash. In 1932, the Dow hit 41. In 2009, the S&P hit 666. In late 2027 or early 2028, we could see the S&P 500 fall from 6.000 to 2.000. This is the moment of total capitulation. Finally, Phase 5 is the slow recovery. The government will eventually intervene with a scale we have never seen before. The Fed will cut rates to zero. Congress will pass multi-trillion-dollar stimulus packages. But because the debt is already so high, the recovery will be sluggish. It took 25 years for the market to recover after 1929. It took 5 years after 2008. The recovery from 2026 could take a decade. Now, we must address the most critical part of this analysis. Who gets destroyed, and who gets rich? Every crash is, in reality, a massive wealth transfer. Wealth is not just destroyed, it changes hands. It moves from the hands of the unprepared to the hands of the patient. Who gets destroyed? The middle class. In 1929, the middle class was wiped out. In 2008, middle-class homeowners lost their equity and their retirement funds. In 2026, the pattern targets the same group. Families with 401ks heavily invested in the everything bubble will see 50% to 70% of their life savings vanish. A $500 nest egg becomes $200 overnight. Homeowners who bought at the peak will find themselves underwater, owing more than the house is worth. Small business owners will face bankruptcy as consumer spending dries up. The tragedy of the crash is that it punishes those who followed the standard advice. Buy a home. Put money in the stock market. And hold. But who profits? The cash holders. The investors who sold before the crash and sat in boring, unsexy treasury bills. When the market falls 60%, cash effectively gains massive purchasing power. At the bottom, when everyone is selling, the cash holder steps in. They buy stocks at 40 cents on the dollar. They buy real estate at auction prices. This is how Warren Buffett operates. He is currently sitting on $325 billion in cash. He isn't waiting for a rainy day, he is waiting for the hurricane. Short sellers profit. These are the investors who identify the fraud and the bubbles and bet against them. In 2008, Michael Burry and John Paulson made billions betting against subprime mortgages. In 2026, the big short will be against commercial real estate and regional banks. Gold holders profit. In every major crisis where the government responds by printing money, gold skyrockets. It is the only asset that cannot be printed. In the years following 2008, gold nearly tripled. In the aftermath of 2026, as the dollar is debased to pay for the bailout, gold could soar to $5 or higher. And finally, the distressed debt buyers, the private equity firms and vulture funds. They are currently raising trillions of dollars in dry powder. They are waiting for corporations to go bankrupt so they can buy their assets for pennies, restructure them, and sell them for a fortune when the economy recovers. This is the mechanism of the wealth transfer. It moves from the reactive middle class to the proactive elite. So, let us look at the timeline, based on the patterns of 1929 and 2008. Here is the projection. We are currently in the setup phase of early 2025. Between mid-2025 and early 2026, we should expect the trigger event, likely a banking tremor or corporate failure. Markets will dip 10 to 15%. Spring 2026 will likely bring the false recovery, the trap. Then, late 2026 creates the conditions for the cascade. The bottom falls out. By 2027, we hit the panic bottom, followed by a long, painful slog of a recovery through 2030. The question now is, what do you do with this information? I am not a financial advisor, but history offers a survival guide. First, reduce your exposure. If you are 100% in stocks, you are gambling on the bubble lasting forever. Smart money moves to the sidelines before the crash. Second, cash is a position. It is not losing to inflation if it allows you to buy assets at a 50% discount later. Cash provides optionality. Third, hold real assets. Gold and silver have historically acted as insurance policies against central bank incompetence. Fourth, prepare your mind. The hardest thing to do is to buy when everyone else is screaming that the world is ending. You must prepare psychologically for the panic so you can act with logic. And fifth, watch the indicators. Ignore what the politicians say. Watch the credit spreads. Watch the commercial real estate defaults. Watch the regional bank stocks. Those are the canaries in the coal mine. The 2026 crash is not a certainty, nothing in economics is. It is possible that the Fed pulls a rabbit out of the hat and engineers a soft landing. But betting on a soft landing when all the indicators point to a crash is a strategy of hope, not analysis. The pattern has been right twice before. The setup is complete. The bubble is inflated. The leverage is extreme. We are simply waiting for the clock to strike midnight. The Great Depression, the Great Financial Crisis, and soon, the Great Reset of 2026. 3 times. Same pattern, same sequence, same wealth transfer. The only variable that changes is you. Will you be the one who didn't see it coming? Or will you be the one who recognized the rhythm of history and prepared? The storm is visible on the horizon. What you do now determines whether you sink or sail.